Hey guys, it's Miss Taylor. We are going over GDP and its cousins packet. So we have all those economic indicators that we've been talking about in class: GDP, unemployment, inflation, and a couple others. So let's go over it together. Hey guys, we're going over the GDP and its cousins packet that we worked on a little bit ago in class. The second page looks like this. It is Part B, GDP. Is it counted and where? So you have 5 answer choices on all of these questions. You're going to write the letter C if it's consumption spending, I if it's investment spending, G if it's government spending, and X, or you could write XN because we've been doing that for net exports, and NC if it's not counted towards GDP. So number 11, you spend $7 to attend a movie. That would be C because that is you are spending money on a good or service. So that is a C for consumption. Number 12, a family pays a contractor $100,000. So that is a house. So even though a family is purchasing it, it's not a consumption. There are 2 things that we as consumers buy. It's actually considered an investment expenditure as opposed to consumption. That's a new house and education. So in this scenario, number 12 is actually I for an investment spending because it's a new house for this year. Well, 13 is a house that they paid 3 years ago. And so it's not counted. It counted 3 years ago, but it's not counted now. So it's NC for not counted. Number 14, an accountant pays a tailor for a new suit, but that's not a business expenditure. I mean, that's not really the greatest example of a business expenditure. So it's C for consumption. While 15, the government increases its defense expenditures by $1 million. That is G for government spending. Of course, 16, even though it sounds like it's government expenditure, Social Security is a transfer payment and it's not counted towards GDP. Same thing with number 17. The stock market, a financial expenditure like that, not counted towards GDP. 18, at the end of the year, the flour milling firm, blah, 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 inventories are not counted towards GDP. Neither is a homemaker who works hard caring for her spouse and 2 children, not counted. If the Ford Motor Company buys automaking robots, that is a business expenditure. So that's I for investment spending. Number 21, $300 a month is counted towards GDP, but since it's not a new house, it's just regular consumption spending. So it's C for consumption. Number 22, Apple builds a new factory. That's a business expenditure, so it's I for investment spending. When RJ Rental Company buys control in Nabisco, I don't know if you're aware of that, but when a company buys another company, they are buying all of its stock. That's how they purchase that company. So that's actually, it's kind of similar to number 17, the stock market. And so that's actually not counted towards GDP. But when you buy a new Toyota that was made in Japan, that's a net export. So you could write either XN or NX for number 24. 25, you pay a tuition to attend college. It's not consumption because remember, it's an investment because there are 2 things that you and I buy. It's considered I instead of C. One of them being a new house that we had on number 12. The other one is number 25, going to college, going to school. All right, guys, the next page on the GDP and its cousins packet is the types of unemployment. So activity 13, and there's only 8 questions here, so pretty simple. And you're given 4 choices. You can write F if it's frictional unemployment, C if it's cyclical, ST for structural, and just regular S if it's seasonal unemployment. So number 1, Wisconsin construction worker cannot find work in the winter. That's kind of obvious. It's going to be seasonal, so S. If it is a steel worker laid off because of a long recession, that's some sort of economic downturn. And so that's going to be cyclical unemployment because of a downward turn in the business cycle, like a recession. Number 3, a computer programmer quits her job in Chicago to look for a new job. Okay, a new job. They're just moving. So they have the skills. And since they have the skills, it is frictional. They have the skills necessary for the job that they want. And so they're just in between jobs, frictionally unemployed. Number 4, a store clerk loses her job because sales are slow during a business slump. Slump, sounds like the business cycle, which means it's cyclical. Number 5, a high school dropout applies for several jobs, but they are not qualified. They don't have the skills necessary. They need to get trained some way, so they are structurally unemployed. An unemployed college senior is looking for their first job. It doesn't say that they don't have the skills, so we're assuming that they do, so that's why it's frictional. Number 7, An unemployed auto worker has been replaced by a robot. So the skills that they have are no longer needed because a robot now does them, and so they're going to have to get retrained because they don't know the skills that are needed, and so that's why that person is structurally unemployed. Number 8, a person rejects a job offer because the wage is too low. That's frictionally unemployed. Um, so you're choosing at this point to be unemployed, and you're choosing to be frictionally unemployed. All right, let's look at the who was hurt and who was helped by unanticipated inflation. So, on each one of these scenarios, you're given a person that they're doing something, and you have to ask yourself if unexpected inflation happens, inflation that they didn't account for, are they okay by this? Are they better off? Are they worse off? Or is it, I don't really know, it could go either way type of scenario. So, on number 1, banks extend many fixed rate loans. So, banks are extending these loans at a certain interest rate that where they assume that they're going to be making some profit. But once again, there's unexpected inflation, which means they're going to actually be hurt by this because the amount that they're getting back, yes, is the same technical amount, but it's worth a whole lot less because of this unanticipated inflation. Number 2, a farmer buys machinery with a fixed rate loan to be repaid over a 10-year period. This is great for them because if there's unexpected inflation, it's a fixed rate. So I locked it in at that really low interest rate or I locked it in at a interest rate. And since prices have gone up everywhere, that amount of money that I'm paying really isn't that much of a problem anymore. So I'm still paying the same amount, but that amount has lost its purchasing power. So great, I'm paying less. Number 3, your family buys a new home with an adjustable rate mortgage. It's really unclear. This is going to be it's an uncertain because it could adjust lower, it could adjust higher. We are typically thinking that they're probably going to be hurt by this, but it's actually unclear because you never know. It could adjust lower than the actual inflation rate. Number 4, your savings from your summer job are in a savings account paying a fixed rate of interest. Yes, you are getting money, but with that and unanticipated inflation, that money is next to nothing. That you could be gaining money elsewhere, and so you're actually being hurt by this because that 1%, 2% of your lucky interest rate really isn't anything anymore. Number 5, a widow lives entirely on income from a fixed rate corporate bond. People that live on a fixed income, whether it's Social Security or whether it's some sort of pension or whether it's a corporate bond, they're always hurt by unanticipated inflation. They're the ones that are really scraping by because they get a certain amount of check delivered to their house every single month, and it's the same no matter what's happening with prices or not. So whether prices are high or in this case really high, unexpectedly high, that's really going to hurt them. On number 6, 7, and 8, these questions were a little difficult because, first of all, are pensions adjusted for inflation? Is Social Security adjusted for inflation? And are dividends adjusted for inflation? And pensions can be sometimes adjusted for inflation. A lot of the time not. If your job even offers you a pension in the first place, chances are they're probably not going to be adjusted. But they might be if your boss is really awesome. And so that's why it's unclear because we don't know if the pensions are going to be paying a fixed amount or if they are going to adjust. Same thing with Social Security. It adjusts every once in a while, but not very often, which is they're probably more hurt than anything, but eventually it will adjust. So it's kind of unclear, like, is it going to adjust tomorrow or is it not going to adjust for another 5 years? And number 8, stock dividends. Not all stocks pay dividends. If you don't know what a dividend is, it's a portion of profit paid out to stockholders on some sort of quarterly basis. It's money just for owning a share of stock. So like Disney might pay 13 cents a share per share for as long as you have it. So, and then you can get gains on top of that. But the question is, are the dividends going to be changing at this time? Usually they're a set amount, but they can change. But how much is unclear. We don't know how much is going to change during that time of unanticipated inflation. Number 9, the federal government has a $5 billion debt. Um, well, that $5 billion debt doesn't seem so bad if all prices go up. It's still $5 billion. But that still $5 billion is worth a whole lot less if the prices of everything go up. And so the government actually gains when it comes to national debt when they have unanticipated inflation. Number 10, a firm signs a contract to provide maintenance service at a fixed rate for the next 5 years. So they said, hey, I'm going to provide maintenance services at $500 a month type of thing. Oh, but now there's inflation and they didn't expect that. So they're actually going to be hurt by that because they signed this contract that they're going to do a job for a set amount of money, but now that money isn't worth very much now, is it? And number 11, a state government receives revenue mainly from a progressive income tax. This one's tricky. It's unclear. And the reason that it's unclear is we don't know how the inflation is going to affect people's incomes, whether they're on contract or not. And then if it affects incomes, how much is that going to affect how much taxes they pay? So it's unclear because we don't really know. That's a really dumb question. Number 12, a local government receives revenue mainly from a fixed rate licenses they charge to businesses. So the local government is now, it's kind of like that contract worker earlier, the maintenance one. They are now getting money on a fixed amount. So they were, hey, every month I'm bringing in $1,000, but now that $1,000 isn't worth anything. So anytime you really see a fixed, chances are if they're getting paid on a fixed thing, whether it's a fixed income or fixed revenue for the government, they're going to be hurt. In this case, on number 12, they definitely are. Number 13, your friend rents an apartment with a 3-year lease. Okay, so this is like a fixed thing, a 3-year lease. I'm going to pay, $500 a month for the next 3 years. But hey, $500 a month with all this unanticipated inflation isn't worth anything anymore. So not bad. I locked it in before prices got too high. So they're actually going to gain in this scenario. Number 14, a bank has loaned millions of dollars for home mortgages at a fixed rate of interest. By this time, you should know that they are hurt because that money isn't worth anything anymore when they are giving out at a fixed rate. Number 15, parents are putting savings for their child's education in a bank savings account. Well, what type of savings account? The savings account could actually be adjusted for inflation, could not. We don't really know. Sometimes some banks have these special college savings accounts that do. Some of them do not. Most of them do not, but we don't really know. So that one's unclear. Number 16 and 17, there are so many ways you could have answered this question about what conclusions you can draw about who is helped and who is hurt. Who is helped? Anyone that is now paying something at a fixed rate is helped. Anyone that is getting something at a fixed rate is hurt. And number 17, if you were certain that the inflation rate would be 10% for the next 10 years, how might you change your behavior? Does your answer depend on who you are, student or worker? You could have answered this in a million different ways. So I'm not going to really set down, this is the specific answer, but this is, might not, if it's going to be fixed for the next 10 years, you could take out a loan. You might not take out too many loans because it's 10%, so that's really high. So however you answer this question, I'm sure is fine. I'm just trying to let you guys think because this affects you with college debt or credit card debt or getting an apartment or buying a house. All these things are going to happen to you in the next 10 years. So do you know how you could be hurt and helped by these things is a huge factor in basically personal finance. All right, guys, thanks for going over the GDP and its cousins packet with me. If you guys have any questions, don't forget to either talk to me in class, hit me up on Remind, or leave a comment down below on this video on Classroom, or just hit me up on Twitter. Or just talk to me in person. Either way, that's fine. But don't forget to like and subscribe. Thanks.